Hi guys, this is Steve O'Hare from Signal Centre, and today I'm going to show you a trading video, how I would look to set up a gold trade, and hopefully it gives you an idea of how analysts look at markets and how we break them down from the larger timeframes down to the shorter term timeframes. So whatever type of trader you are, whether you're an investor, whether you're a swing trader, or whether you're an intraday trader, there'll be something in this video that you may be able to take away from it. So I'm going to basically run through good ideas behind trading and setting up your own strategy. So when we talk about trading, there's a few things that really you have to have in place before you even attempt trading. Now, a trading plan is critical. Basically understanding what your risk management's like, what market you want to trade, what capital you have to risk, and a way of prolonging the opportunity. Basically, you don't want to be blowing up a trading account within the first few months, which is tends to be a bit of a trend that we see in the markets. You can see whatever platform you go to set up a trading account, they'll have a percentage of traders lose money with this broker, and it's usually pretty high. So the idea from this is you learn a little bit and maybe take it away and last a bit longer, which gives you a little bit more chance of success, and hopefully you can learn from that. The trader in you, that's a little slide I'm going to do, and it's really to understand what type of trader you are, because intraday traders are very different to investors and swing traders. So it's just I do believe that most people can be taught how to trade as long as they have the right plan and tools. It's not always the case, but I think most people can. I do believe that, but they have to be disciplined. They have to follow the rules, follow the plan, and you know, every person is different. So every trader is different. So every person out there will have a some sort of risk threshold that they can go to and maybe not pass. So we'll talk a bit about that, and also analysis. Another key thing to understand, whether you're a fundamental analyst, a technical analyst, a sentimental analyst. There's plenty out there. And finally, I'll go on to gold ideas, and I'll start with a basic chart, and I'll show you how I can set up a trade idea. And yeah, hopefully you won't be bored by that time we get to there. So a trading plan, really, what does a trading plan need? Well, there's 5 key items it needs, and probably a bit more, but I'll just try and stick to these 5. We can go into more depth on them at a later date in a whole webinar or whatever, but we've only got sort of 15-20 minutes, so I'll go through it as briefly, and try and keep your attention span, which is a lot of the problem with traders nowadays. They can't really stay focused for long enough to learn what they should be learning. So rules, the rules have some rules in place. This can be built around your trading plan. This is to keep you safe, to basically stop you blowing your account out of the water before you even get started, before you even get an opportunity to learn. Because I've been in the market over 30 years, and I've learned most of the things that I've learned is by just watching markets, studying markets, understanding, going away, doing my research, coming back, and then pulling the trigger and doing the trades. And over the years, I've had some good success. Over the years, I've had some bad times as well. So you do have them peaks and troughs. It's not just a straight line. I've never really had a capital a bank trader would have. It's always been sort of personal capital or things like that. So there is opportunity out there. So just try and have rules in place that you stick to. So discipline is key to that. Patience, understanding the markets, expectations, managing your expectations. Don't just think because you've opened a trading account with £2,000 in it that you're going to make £20,000 in a very short space of time. That can happen, but the chances are you're going to lose that money if you risk too much of it too quickly before you know what you're doing. So you know, if you want to look at trading as a secondary income, then you have to put just as much work and effort into it as you do your day job. You know, this is to become an expert in anything takes something like 10,000 hours. So think about that. It's not going to come quickly. There's no holy grail out there. There's no easy route. It's a lot of hard work, a lot of time, a lot of dedication. Am I putting you off? Maybe. So that's maybe not a bad thing. So research, do your research, understand the market you want to trade, have something which allows you to enjoy that, something that sort of like makes your mind work, gets your brain ticking. Go out and do the research, and you know, just spend time doing that. The harder you work, the luckier you will get. That's how it works. The harder, the more effort and time you put into it, you know, the more opportunity will come to you. It'll feel like you're getting lucky, but maybe you've put more time than someone else who feels a bit unlucky about it. Risk. So understand what you're willing to risk. Have a trading account which has money in it which you're willing to lose. Don't just open a trading account with money in thinking I'm willing to lose that money and just flip a coin and go one way. That's pointless. That's just luck. But please understand that you can lose all the money in your account. That's like key to everything. We aren't going to give you any magic formula to make money. We're going to give you tools which will educate you and help you do the right things. But please take into account this consideration. There's no guarantees, and you could risk all your money. There was a saying before that you could lose more than what's in your account, but a lot of retail platforms don't allow that anymore, which is a good thing. But yeah, let's try and sort of understand that you have to speculate to accumulate. So there is risk involved, and it's just how you manage that risk. Analysis, again, different types of analysis: fundamental, technical, sentimental. We really focus on the technical side of things, but I like to have a handle on what's going on in the fundamental picture and understand the sentiment in the markets. So there are times when the technical picture is pointing upwards, the fundamental picture is pointing upwards, but the sentiment of the market isn't in time. When it's all going in the same direction, that's when you get the big trends. But contemplate the fact that markets don't trend upwards or downwards all the time. There's a lot of sideways movement in the markets. And the last thing to contemplate in the plan is the psychology. Just maintain the focus and try and keep the emotions out of every trade. Just have the plan in place and plan the trade the plan. Hope that makes sense. As I say, the trading you, I think there's three real types of traders. You've got the investor. They're the guys that are looking for the long term, the pension guys, the long term investors, buy and hold. You know, that may be you, may not be you. You know, hopefully, even if it is you, you can maybe take away from maybe you analyze the fundamental side of things. And I do believe in that, and that's great. But also maybe if you understand or learn a bit more about the technical side of things, it may improve your entry point into a trade, or it may give you a better understanding of what's going on in the market. You get the swing traders, put swinger in there just as a little bit of a comical thing. The swing traders are the guys looking for maybe the medium term moves, where the market, they don't care if they're long or short. That they just want to sort of capture decent moves within the long-term trends. So there's a good portion of guys out there. They have a lot more patience than the intraday traders. They have maybe different ambitions in terms of what they're looking for as a return. So you know, there's plenty of guys out there who do really well. Going back in the early days, I was a day trader on the live floor, and that was very much intraday trading we would look at. We wouldn't even contemplate where the market was going after that day finished. We'd open and close hundreds and thousands of trades during the day, and at the end we'd have a flat book. So that leads us to the intraday trader. A lot of people don't like to have overnight risk or over the weekend risk for obvious reasons. You can get a lot of moves that happen over the weekend and overnight, and you could end up with a position where you were looking to make just a few ticks, which could be way offside the next day. So intraday trading generally end up with a flat book. So I think what you've got to do is work out what type of trader you are and what type of trading strategy suits you. So again, the analysis, fundamental, technical, sentiment. So we're really going to focus on the technical side of things, and I'll run through the chart, and I'm going to talk about gold. Gold always seems to get people interested. It's done that for mankind for years and years and years, so that's not going away. And even with the recent sort of like stock market moves, we had some moves in gold which really left a lot of people scratching their heads, including me, for a little while until I did a bit more research and found out why. So we'll go over that. So trading gold trade, what do I need? I need a chart. This is what I need. I need a chart. I like candlestick charts. I've studied candlestick charts for a long time. I need to understand the trend of the market, not just the trend over the short-term time frame, but also the longer-term time frame. I'll talk a bit more about that. I like to look at certain indicators and use certain indicators. The candlesticks is an indicator. That's just a form of a chart. ATR, the average true range, is an indicator. I could look at any market in the world, and in a short period of time, I'll have a good idea what the expected range is on any given day by taking the ATR, the average true range. It's a very simple indicator that can be used and give you an idea of where the risk is or what the risk is. Cloud, the Ichimoku cloud. I've done a PowerPoint slide presentation on that, and take a look at it. It's on the YouTube channel, and I use that as my go-to graphic, because I am a bit of a visual learner and prefer to see things rather than have to read books and books and books about it. That's why I like to do the videos. Fibonacci's, they're always a great indicator to show us where we expect the move to come back to. So we get a fast move upwards. We're expecting a pullback because markets just don't go up in a straight line or down in a straight line. So we look for the Fibonacci retracements. Risk, know what I'm going to risk on a trade and stick to the plan, and then pulling the trigger. So that all that goes into a trade idea. So let's just lose the presentation for a second, and I'll bring my chart up. Where's my chart? This is my chart. So also what I'll do is I'll give you an idea of what we do on a daily basis. This is our free widget. This is our free trade ideas. We write over 30 trade ideas each day. We use technical analysis in all those trade ideas. We have 3 expert analysts, and we have other analysts working for us, and we use our strategies and overlay our strategies onto an intraday method. So this is what you'll see every day when you come to us. Not all the trades make money. We have probably about 43% hit ratio or win-loss ratio, but our risk reward is skewed to the positive side. So we're always trying to get at least a 2-to-1 risk reward strategy going. So that means if we're going to risk $100, the target for that trade would be $200. Or if we're going to risk $50, the target would be $100. It's at least 2-to-1. That's what we try and do on a daily basis. And when you work that out and you apply that to all your trade ideas, you don't need to have more than a 50% win-loss ratio. 41-42% has given us a decent performance over the last 5 or 6 years that we've been monitoring it. So think about that. Have a look at this for signalcenter.io. Go on that. That's available at the moment. It's not behind any paywall. It's a free trade idea. Gives you a trade idea, gives you a full report, gives you a chart, and gives you the analysis behind it, and also tells you when the trade, we update it when the trade's triggered and everything. So before I go into there, let me just try and see if I can bring up my MT4. This is a typical MT4 platform. This is IG's platform. They have our trade ideas on there as well if you're an IG trader. But this EA isn't available everywhere. So this is our EA. This is what we use to monitor it. And we can click through the charts, but it just gives you an idea of what we're doing on a daily basis. Let's get rid of that and let's bring up the gold idea. Now, how long are we in? We're 15 minutes in and I haven't given you the gold idea. Maybe I should have saved that for another day. Right, let's look at the gold chart. This is what a lot of you will be interested in. This is a monthly chart in gold and this is a line chart. Now, I don't really like line charts, but when you're looking at long-term charts, it's a good idea to start with a line chart. This will give you just a visual representation of what the market has done on a monthly basis since 1971. Now, not all markets will go back that far, but gold has obviously been around for a long while, funny enough. So let's change it to a candle chart. I like candles. We color our candles light blue, dark blue. And this gives me a little bit more information. So this gives me not just where the close of the day is, which is what the line chart shows, but this also gives me the open, the high, the low, the close. So in this, I'm not really going to focus on what was going on back here, but let's just draw a simple Fibonacci in, and this will give you a little bit of an indication. In fact, what I'll do, I will take it. Let's take it back to where the real up move started. Let's take it back to here. So this is February 2001. So this is when the gold prices started to pick up. $250 back in 2001. Doesn't sound bad, does it? But we had the real move higher really happened around the financial crisis. So when the financial markets were taking a big hit, gold became a safe haven, and you'll always hear it referred to as a safe haven. There's a few things I'd like to discuss about that a little bit later if I can remember to do that. So the market moved up, and as I said, markets don't move up in straight lines. They move up in waves. We look at Elliott wave as a really decent sort of like methodology behind how markets move. And normally what we do is we take an Elliott wave and we take the impulse wave. So we might get let's see if we can get this going. Now this could be fourth wave correction to a fifth wave, which could be way up here. Who knows? But there's a few key things to know about Elliott wave. You have the wave one, the first impulsive wave, then you have a correction, and whatever that correction is, it is going to be different to the wave 3-4 correction. So this is a small retracement here, a small sharp one. This is a long drawn out retracement. You sort of get that in technical analysis, but I haven't got time to go into it. Now the key thing, the wave 4 can't go lower than wave 1, the high of wave 1. So there it doesn't, it nearly does, it doesn't though. So that can count as a wave 3-4, and then wave 5 we don't know where it's going. So what we are looking for, what this does, it indicate we're still in an upward trend. Let's get rid of Elliott wave. I don't really want to confuse everyone too much on that to start with, but let's bring in one of my indicators that I really like as well. Let me just. I've lost all my notes, but never mind. Let's bring this back. I wanted to focus on a few things, so I'll leave the fibs in there for the minute. And actually I won't, I'll take them out, and I will introduce you to one of my favorite indicators, favorites, C, is Ichimoku cloud. Now the cloud is, again, I've done another slide on this as well. The cloud is can be a trading strategy also. There's 2 or 3 different trading strategies within the cloud that are well worth learning about. But what the cloud does for me, it gives me an instant visual representation of where the market is in whatever time frame it's in whatever trend it's in. So here, that straight away, all the way back here, this chart, you can see the cloud projects. It's 26 candles in front, so that'll be 26 months in front. So back here in March 2003, I would have had the next 2 years of cloud would have already been there. So that would tell me that around this time, so if I go back 26 months, that the market starts to pick up here. The market was starting to turn from this red cloud to the green cloud. So that's from bearish to bullish. Price action broke through the cloud here, and projecting forward, that showed that the green cloud was appearing. So that was the start of an upward trend. Now, I did have no idea that the trend was going to be as aggressive and as long and drawn out as that, but I knew it was a positive move to the upside. So that allowed, if you were to use the Ichimoku cloud on a monthly chart, you would have got a buy signal around about here, March 02, and that would have been confirmed by a move through the cloud in December 02. So over that year, you'd have confirmation and a trigger to get long of gold, way back at $350. So also the move higher, you could have had a strategy where, right, I'll only get out of this trade if the price moves back through the cloud. So you would have got out at $1,200, but you would have missed this move up to $2,000. So you know, we all have different ideas of what we're trying to target when we first put a trade on. A long-term trader may have been looking for a good sort of 10, 20% over a few years. Short-term traders would have just been trading this intraday. So let's not focus too much on the monthly chart, but it does give you a little bit of a picture of what's gone on over the last few years. I mean, this is my period I really want to focus on, 2011 to today. So not 9 or 10 years we're thinking about in this. And this looks like the price has moved down, bobbed along nicely and moved higher. But for me, it was a little bit different. I was looking at something on a shorter term time frame. And for that, I'll bring the weekly chart. So I'll bring it down a notch from the monthly chart. And it's something I've written about for over a year, good 12 months. And it's one of my favorite formations is head and shoulders formations. So this was a reverse head and shoulders formation. And this was a complex one. And I'll explain a little bit about that. So this is what I was looking at, thinking, right, okay, formation, the neckline's about to break. I've done some reversal formation videos, have a look at them. And it didn't break here like I expected. Instead, it had another right shoulder. This is what the complex formation is all about. It can have two right shoulders. And if we look at it, it had two left shoulders here as well. It had the head and two right shoulders. So when it eventually broke, which was here, 17th of June, $1,353. Now, the measured move target for this was roughly here. And I presented this to a group of clients probably about 6 months ago when we were trading around about down here. So, you know, it is after we broke through, this is when I was talking to the clients. I said, look, this formation's taken place. This is where it's got potential to go to, and it's gone to there. But for me as well, this is the correction, the fourth wave correction, we've got a bigger fifth wave correction to come. So long term, I'm looking at that to go a lot higher. So there's my view. Long term trend is up. Let's try and break down the timeframes and look at what most of you are interested in is, let's take away all the drawings and we'll take away the cloud, is what's going on a daily basis, because people, day traders especially, want to trade on the day. So we only have to look back, you know, a few days. If you're trading on an hourly chart, you only have to look back a few weeks. You obviously, if you look at the longer term timeframes, think about where the major levels are. As we just showed, the 1700 level is now a major level. the lows back here, going back to March March, just sort of like a few weeks ago. That's a major level. Let's take it back. Let's go back on a daily chart. Let's just get some daily figures in there. Funny enough, swing low was very close to this swing low. You know, support, resistance, horizontal support, resistance. They're key levels. We'll have trend lines in there. We'll have everything in there. But we really want to focus on where to next. I think really for the intraday trader, he's really got to have an eye on the daily chart. You have to have an eye on the higher time frames and the lower time frames, whatever you're trading. So let's look at the higher time frame, daily chart. Again, let's draw that reverse head and shoulders in, because that hasn't gone away. That's still sitting there and can still, yeah, let's get it up there. All right, it doesn't look as pretty now because I can't quite get it to stick to that point. But there, so this got to have an eye on this trend line here. Have one BDI in this reverse trend line. What used to be resistance is now support. So we've got a lot of support down here. This is down at 370. And again, when you have these inverse head and shoulders and head and shoulders, a lot of the time the price action does come back. And I was telling clients back here that the price action tends to revert to the neckline before it goes again. Is this the reversion to the neckline? Still don't know yet. Still playing out. We've had this sustained volatile period. We've got to be really careful with this. It's a little bit of no man's land. That's where we are. So anyone looking for, you know, the winning trade today is not going to get it from me. I always look at markets and think, right, we have a market. We have, let's bring the ATR into it, which I talked about earlier, average true range. So this is an hourly chart, and the average range in each hour. You can change how you want to. This is the last 14 hours. The average range is 8 ticks, $8. So we're trading at $1,587. In the next hour, we'll have potentially a $4 a rally and a $4 swing low. So that's what all these bars are made up of, on average $8 over the last 14 periods. Let's go back a little bit further. Last 100 periods, a little bit more time, $11. Taking it back to the 25th of March, we were getting $15 swings on the hourly chart in an hour. I mean, you can see the spikes. And now the spread has blown out because there's been a big detachment from the physical gold and the traded gold. That's got to be considered when you're trading. But it seems to have settled down over the last few weeks. A little bit of more liquidity's come back into the market, but there's still a long way to go. Where's the market going now? That's the sort of like key to it. And the only thing that I've liked over the last few weeks is this. I like this double bottom. The double bottom had a measured move there. So when price action broke above the neckline of this candle here, or wherever the high was here, 15.54, the target became 16.55. So you're looking at $100 target for that double bottom. This bottom here, this bottom here. That's what we were looking for. It wasn't far away from achieving it. Got up to 16.44, 45, and it stalled. And again, it looked like it was forming a bit of a bullish flag here. Again, price action over the last couple of days, stock markets have taken another hit. It's impacted again on gold, and that's where we've seen over the last month or so, where stock market valuations were way overvalued. A lot of hedge funds, a lot of big banks long of the stock markets, the equities, and what they do is use gold as a type of hedge to their sort of like equity position. And stock markets crashed very aggressively, very quickly, very violently, and a lot of then holders of the gold on the on the sort of like and equities had to sell gold to maintain their equity positions. So this was the big sell-off we had. Gold moving from $1,700 to $1,445 in the space of a few weeks. When you would have thought that gold should be going higher if equities were coming lower. That's the normal mode, but it wasn't a normal market move, and it definitely impacted heavily on financial losses across the globe. So a bit of stabilization, markets rallied, gold rallied, again, not normally the thing, but there is something to consider. In periods of really high volatility, you know, some we've seen recently that we haven't seen ever. The dollar is the safe haven. That's where assets go. So if the dollar is getting stronger, then gold would naturally, this is gold against the dollar. So gold would naturally come lower. So it's more of a dollar safe haven rather than a gold safe haven. Now, once volatility quietens down and we do move volatility becomes a little bit more normal. Look at the VIX index. That's the gauge. When that normalizes, maybe back to like the 15s or the 20s, whatever normal is now, then I expect gold to go higher again. I don't know when that'll happen. I still believe we've got a little bit of a swing lower to come in gold, so to come in equities. I don't think the bottom's in place. I wish it was, because it sort of like doesn't paint a really nice picture of the economy as a whole. So but that's where my view is. We can see gold being bashed by the dollar, so we could see gold lower in the short term. The long term, even I would be considering being an investor rather than an intraday trader if gold was to get back to these 1450 to 1350 levels. That would be, for me, the real play. Whether you have to own gold physically or you can just sort of run it on your trading account, I don't know. I can't really give you a clear answer on that, but having physical gold around about these 1350 to 1450 levels would be a great long-term opportunity, I think. And maybe if the fourth to fifth wave could be the retirement trade, who knows? I hope you've enjoyed the slideshow. I'm going to sign off there. I've taken up way too much of your time. Feel free to contact me on the details you see in front of the screen, and I look forward to joining you again with more trading gold. So speak to you all soon.